We got a very special episode on today's podcast because we're going to solve a problem for a lot of people out there. What's the problem? Well, it's all of the people that bought real estate in 2021, 2022, people that bought real estate as an investment, thinking they were going to have a windfall of profits, win the lottery, have an incredible experience in terms of what they were buying for at the time versus what they might sell it for later on. Well, bad news. That never materialized, and that never materialized for a lot of people. So, what's the current day problem that these guys are facing? Well, these people, they bought for incredibly high prices at the time, prices that are no longer achievable by current market standards. Not only that, but they also got into higher than anticipated mortgage rates. So when they either completed on their property, whether it was relatively recently or years in the past, they signed a mortgage that was a lot higher than what they thought it might be at the time. Now, things over the years, there's no doubt, have gotten much, much more expensive. And this is everything. I'm not going to go over the whole list of everything that's gone up. I think you're smart enough to know what that is. But here's where the challenge lies is many of these people who bought investment properties, well, not only are they worth less today than when they bought them, but they also aren't cash flowing, meaning they've put tenants into these properties to try and offset some of their expenses and maybe wait the market out. But the challenge a lot of people are running into is the rent, and the rental amount is simply not covering their expenses. It's not covering their mortgage plus their insurance plus their strata fee plus all the other add-ons that go on to there. So many people are actually finding themselves in an environment where they're burning money every single month. They're losing money. I've seen people in my travels calling me that bought properties from developers and are trying to sell them, and they're losing sometimes 1,000, sometimes $1,500 or even more per month, just on carrying costs. So they've got two problems. Not only are they burning money each and every month, just slowly whittling away at their bank accounts, but even if they did want to try and resell their property, they feel like they can't. They feel like they're stuck because they're going to lose so much money. For the case of a Surrey condominium, as an example, for somebody that maybe bought from a developer at the peak after paying property transfer tax and GST and paying a premium for a brand new unit at a time where developers get away with charging a ton of money. Some of these people that are looking to resell these units that maybe just completed, like they were just taken possession of, sometimes like 100 to $150,000 less than what they're in for. So the reason I'm excited to share something with you today, it's a little bit different, but it's an interview with one of my favorite people. His name is Jimmy Letang from Achieve CPAs. And Jimmy and I have been going back and forth on some solutions for people that are finding themselves in this situation. I think you're going to really enjoy this conversation because not only is Jimmy a wizard when it comes to taxes and understanding how to make things make sense for people, but there is an incredible strategy that he's going to share with you. And it's one that if you're someone that's finding yourself in this situation, one where you've got a property, you want to sell it, it's burning money every month, and you really just want to get rid of it, but you're going to take a loss. Well, Jimmy's got a solution for you. And the good news is it's a really palatable one. It's one that I think a lot of people are going to be able to stomach. So, anyways, without further ado, I'm going to jump into my interview with Jimmy Letang from Achieve CPAs. And I really hope you enjoy it. All right. Looks like we're good. Okay. Good to go?
Yeah, we're live.
All right. Jimmy Letang, we have a large problem today that we're going to help and try and solve for so many people that got caught up in the hustle and bustle of buying properties, investing in properties in, let's say, 2021, 2022. And those people are having some real challenges right now. Those people are having challenges carrying the property generally month to month. Oftentimes for what they're paying in their mortgage and what it's costing them for strata fees and insurance, the monthly rent just isn't paying the bill. So there's people out there that are actually actively losing money each month. But worse than that,
Naturally, somebody in that situation would want to sell that property. They don't want to get rid of that losing investment as quick as possible. But they also bought it at a price that the market will no longer bear. And should they want to go and try and sell that property, they're likely maybe selling it at a loss. Maybe they bought a pre-sale and they paid GST and property transfer tax on it. We'll unpack that a little bit as well. But nonetheless, they got in for X amount of money and they're going to sell it for X amount minus a couple thousand, 10,000, 50,000, $100,000. So the purpose of this conversation is to unpack some strategies and even just some conversations or some thought points that they could consider to help themselves recover money as best as possible, stop the burn, all that sort of thing. So I am so excited to have you on here today. I will let everybody know what your and my personal relationship is here in a moment. But before we get into that, I'm speaking with Jimmy Letang from Achieve CPAs. And Jimmy, I'd love you to give everybody a real quick, background on who you are and what you do.
Oh, thanks, Darren. Yeah, we've been working together for a long time, Darren, and I've known you personally for, I mean, a very long time, and of course, professionally for just as long as well, too. And in terms of myself, I'm a partner here at Achieve CPAs. My area of expertise is in relation to real estate taxes. So anything that touches on to real estate, be it income tax, GST, a capital gains issue, BC speculation and vacancy tax, or I don't know, their underused housing tax, whatever. If you name it, I probably have something to say about it. So yeah, I'm happy to join you today, and hopefully we'll get some information off to your viewers that'll be useful for them. And if we happen to save somebody some money in the course of doing this thing, then I could be happier with that result.
Yeah, I'm really looking forward to this. You and I had some offline conversations about this, and I think we've got some really great things here for people to consider. For people that don't either know yourself or myself, we've had the good fortune of knowing each other. Geez, probably for almost 20 years now, and
What do you think?
yeah, yeah, I think it's about '09. So I actually got introduced to you, helping you with your real estate needs, and then you started helping me with my tax needs. And we'll save all the great stuff that I've hopefully done for you on the real estate side, but I can speak with complete clarity and assurance that you have helped me so much in my professional career in terms of helping me do the right things tax wise, helping me be intelligent about money regarding taxes, and there's nobody that I know that number one is as energetic and loves talking about tax as much as you, which so if you love talking about that, you're the guy. But you've certainly been a huge asset to not only myself personally and my family, but also my clients. So I'm so excited to have you here and chat about this.
Oh, that's amazing. Thanks, Darren.
So let's unpack this a little bit. So I kind of described the problem, people burning money each and every month. And not only that, as terrible as that is, they also want to sell, but many of them feel like they're unable to because they're going to take a loss on the property. And nobody wants to do that. Now there's kind of two things there. I mean, taking a loss on a property is one thing, but sometimes people choose not to sell because they literally can't. Maybe their mortgage is higher than what they'd be able to sell it for. That's a problem that's very, very difficult to solve. You need to have the money to be able to do it. But a lot of the times it's more in their mind, right? They bought at a watermark that's up here and they're selling at a watermark that's down here. And they just don't like the idea of selling at a loss, but they don't want to keep on burning money month to month. So I kind of have three points that I wanted to really try and pull out of you and your infinite wisdom in this video to and the first one revolves around current expenses. So I'd love for you to explain to people, for those that maybe consider keeping their investment property, we want to make sure that they're making the most use of any dollar they're putting into that investment. So, how can we help them recover that as best as we can? So, can you talk a little bit about current expenses and how they can use current expenses, what sort of current expenses they can use to actually help offset their tax burden?
Yeah, so current period expenses are anything that you incur in the current tax year to maintain, keep running this rental property. So some of the obvious ones are, your strata fees, your insurance annually on the property, your property taxes. Some of the less obvious ones would be your interest on the mortgage. So a lot of people are always thinking about the mortgage as a single number containing the principal and the interest component. And then when they get to doing their tax return, they forget that the interest component is tax deductible. So while the entire mortgage payment is not tax deductible, the interest part of it is. And on every year, your bank will send you a mortgage statement that covers the entire calendar year. And on that mortgage statement, they will specify exactly how much interest was paid in the year. And that's the dollar amount that you can deduct against the income that you've earned. So that'll reduce your tax burden. Other things that would reduce your tax burden, if you have like a detached home and there's like landscaping, cutting the lawn and all those kind of things, you can deduct that as well too. If you hire an accountant to help you prepare your tax return, that's also a tax deductible expense. If you've borrowed money outside of your mortgage, let's say maybe you have a separate line of credit that you've been dipping into to finance the ongoing expenses. Well, the interest component on the portion of your line of credit that was used for the property, that's also interest as well. And you could deduct that against the rental property income. So there's lots of little things like that that people tend to forget about because it's not an immediate and direct expense that they're paying. They might not see that as a tax deduction.
Yeah, that's right. So, I mean, there's so many things there that I think oftentimes people forget that they can use to kind of offset the pain that they might be going through right now. But this is for anybody that's, whether they're making money or losing money, there is opportunity there to offset some taxes because it's an investment. Now, one of the things that, doesn't help the situation, and I mean, there's tons of different business models out there for selling a home, but selling a home typically isn't overly cheap, right? I mean, you've gotta pay for services, and this isn't to get into real estate fees and stuff like that, but typically it's gonna cost a little bit of money, and usually that's based off a percentage of the price of whatever the home sells. So, talk to me a little bit about that. Like, is there something that can be done there, when somebody sells a property with, like, the real estate fees?
Yeah. So when you sell a property, you would report the sale on your personal tax return, and there's a box for proceeds of sale, which of course is just the sale price. There's a box for adjusted cost base. Now, adjusted cost base is, I mean, some people think it's just your purchase price, but there's more to it because your adjusted cost base is not just your purchase price, but you also have to add in your purchase cost. So if it was a brand new property, you're adding in the GST. Whether it's a new or existing property, you got property transfer taxes. So that becomes part of your purchase price. If you hired a lawyer to help you with the conveyance on the purchase, your legal fees become part of your purchase price. So anything that you incurred as a cost to acquire the property becomes part of your adjusted tax cost. So your tax cost is higher than just your purchase price. So and if you include all of that, it'll reduce your capital gain, obviously, right? And then there's another box on your tax return for something called outlay. And outlays are your costs in respect of selling the property. So any fees incurred for selling the property, like legal fees, realtor fees, maybe you paid for some staging costs, and your realtor didn't pay for that. Maybe you paid for it. Then, your staging costs will become part of your outlays as well. So anything that you paid in connection with the sale would then be deductible against your net sales proceeds. So then what you're left with is net sales proceeds minus your adjusted tax costs minus your costs to sell is your capital gain. And of course, half of that is taxable. And if you're in the unfortunate position where you're selling ultimately at a loss as well, you end up with a capital loss. Now, a capital loss is not immediately deductible against your tax return. It is only deductible against other capital gains on your tax return for the same year. So maybe in that year, if you've got some capital gains and now you have, you'll sell that property and then you can also utilize that loss against those capital gains. But if you don't have any other capital gains in the same calendar year, your capital loss does carry forward. So you can use that capital loss against future capital gains. So it's not an entirely wasted loss. You do get to to move it along to, I think it's up to 20 years or so, which is, a long time, right?
Yeah, yeah. Well, and that's the big piece that I want people to really take away from this. So I think a lot of people really understand what a capital gain is, but they don't necessarily understand a capital loss. And effectively, it's just the opposite of a gain, right? But that capital loss, that's not necessarily gone forever. So I want to give an example, and I want you to kind of correct me if I'm wrong. So if I had a condominium that I had purchased, and after everything's said and done, let's say I have to sell it for $100,000 less than what I'm into it for. That would represent, effectively, or, just for ease of conversation, let's say that was a $100,000 capital loss. Now, if that carries forward into the future, the only way that I can benefit from that is I have to have a capital gain, right? That means I have to make money on another investment somewhere to be able to use that capital loss to offset it. But here's the thing I don't think people really think about. Let's say you've got investments in, whatever you've got, right? Let's say you've got some stocks and some bonds and all these different things that, a lot of people have different irons in the fire. And let's say you get to a point where next year you had a $10,000 capital gain. Well, you can offset that $10,000 capital gain with a portion of that $100,000 capital loss, meaning you still have $90,000 of a capital loss. You've offset your current capital gain. So it's like it didn't exist. And you still have that $90,000 to carry over into year two, year three, year four. So a lot of people, I think, don't appreciate that, while they're burning cash monthly, losing money because their rent on these properties simply isn't covering all of their expenses, there is a mechanism in using that capital loss to recover that money over the long term. You just don't get to realize it today. Is that a fair statement?
Yeah, that is a fair statement. On Darren, I'll also add to it too that, if you have capital gains in the previous 3 tax years, you can carry back that capital loss 3 years as well. So, we're into 2025 right now, and by the end of the year, you sell your property, you've got a capital loss. When you go to file your 2025 tax return, you can look backwards in time up to 2024, 23, and 2022. And if you have any capital gains in any of those 3 previous years, you can carry back your capital loss to those 3 years and apply your capital loss immediately against those 3 years. So that way you can then, recover some of the taxes that you would have paid on your capital gain in those 3 previous years, right? So yeah, you can carry it back 3 years, but you could also carry it forward 20, right?
That's incredible. So we can go back in time and even get money back from other things.
Yeah, yeah. So I always say to clients is it's better to carry back a loss and utilize that loss right away because there is that 3 year time limit. So if you've got a capital gain that you incurred in 2022, maybe you sold some other property in 2022 and you have a capital gain there. Well, if you don't take that capital loss in 2025 and apply it against 2022, but then maybe you sell it in 2026 instead. Well, by the time you get to 2026, that 2022 capital gain is now untouchable because you can't carry back 4 years. You can only go backwards 3, right?
So I think this is really helpful. So for anybody, we primarily take care of like the Surrey market and surrounding areas. So like, Burnaby, New West, South Surrey, Cloverdale, that sort of thing. But for anybody really in the lower mainland, or I guess really anybody across British Columbia or Canada that's watching this, unless, yeah, I mean, unless the tax code is insane, right? So it's a federal thing. So this is really good advice for anybody that's in an investment property that's currently underwater, but they need to sell it. They want to sell it. They're just worried about losing all that money. So I want them to come out of this feeling confident that as long as you can produce capital gains in future years, which ideally is the case, you're going to continue to invest and maybe you don't choose real estate as a vehicle for that. Maybe it's something else. But whatever that might be, you can offset any gains in future years with your capital loss today. So you're kind of, unfortunately, taking money out of your pocket as of today, but you're helping add more money back into your pocket in future years. Is that a fair way to sum that up?
It's definitely fair. I mean, it's tough to lose money at any point in time, but you know what? Sometimes you just gotta cut your losses, right?
Yeah, yeah. Well, I mean, the some of the stories I'm hearing right now are heartbreaking, and thankfully, they're not clients that we've put into, these places, but they're people who nonetheless, whether they bought directly from a developer or, just bought as part of a frenzy and whatnot, especially when they're burning money every month. I mean, I've met people losing $1,500 a month, and they're, gonna have to sell at a loss, but at least with this strategy, it kinda helps outline that there is a future there. You just don't maybe get to enjoy it immediately, but and may actually, to your point, maybe you do because you can go back into the future 3 years, but whether that's the case or not for that particular person, there is hope there that you're not just losing all of that money.
Yeah, that's right. And I do want to caveat too that, your capital loss is predicated on the fact that the property is not a flipped property, right? So that's really important because under the Canada Revenue Agency rules, a flipped property is a property that you've only bought and then have sold within 1 year of ownership. So if you have only owned this property for a year and you sell it and you do incur a loss, the loss is deemed to be nil, right? So you won't get a capital loss there. So it's really important that if you are looking to sell a property, there's going to be a loss there. You want to utilize that capital loss against something else. It's not going to be on a property that you own for less than a year.
Jimmy, this has been incredibly valuable, and just like when I sit down with you for my own personal stuff, I feel like anybody watching this video has just made some money. So I want you to let people know how they can, track you down and get a hold of you.
Yeah, our website is achievecpa.ca. You can find me there under the list of partners. My email address is jimmy@achievecpa.ca. My phone number is also on there as well too. Yeah, or you just reach out to Darren. You can get in touch with me through Darren as well. So whichever way is the easiest for your audience.
Absolutely. Well, hey, I appreciate you, buddy. Thank you so much. You helped a lot of people on this one, and, please reach out to Jimmy if you got any more questions.
All right, thanks.
Thanks, Jimmy.